All right, let's talk about Applied Digital, APLD. If you've been following this stock, you know it has been on an absolutely incredible run. But if you look a little closer, the picture starts to get, well, pretty messy. It's a classic technical tug of war, with the bulls on one side and the bears on the other. So let's break it down and figure out what the charts are really telling us.
Now, at first glance, you'd think the bulls are winning. The stock closed the day up over 2%. And on any other day, you'd probably just see that and think, great, the trend is still up. But with APLD right now, that's not exactly the whole story. Because once you start peeling back the layers, that simple green number, it starts to look a whole lot more complicated. The real story is what's happening just beneath the surface. So what's the deal? Is this stock strong, or is it showing signs of weakness? That's the big question we're going to unpack here. We're going to look at this powerful long-term trend that's been pushing it up, and then we'll look at some pretty worrying short-term signals that are pulling it down. Okay, so let's start with the good news, the case for strength. To really get a grip on where APLD might be headed, you have to appreciate the incredible momentum that got it to this point in the first place. I mean, just look at this journey. The stock has climbed all the way from a 52-week low of just $2.60 to where it is now over $11. That's a massive, undeniable uptrend, no question about it. And to put that into perspective, the stock is currently trading in the top 10% of its entire price range for the year. That tells you it's holding on to most of those huge gains and is still sitting very comfortably near its peak performance. The underlying structure looks really healthy too. The price is trading well above its 50-day and its 200-day moving averages. You can think of these averages as a kind of safety net or a baseline for the stock's long-term health. And as long as the price stays above these lines, the big picture, it's still bullish. But that's only one side of the rope in this tug of war. Now let's switch gears and look at the other side, the case for weakness, where honestly some pretty serious cracks are starting to appear in the foundation. And here's where the plot thickens. While that long-term trend is still solid, the stock has actually slipped below its short-term 5-day and 20-day averages. It's kind of like a sprinter who's still in the lead but is starting to slow down. It's a clear sign that the immediate day-to-day momentum is fading. And check this out. Another major warning sign. Remember that 2% gain from the beginning? Well, it happened on really weak volume. In fact, volume was down by almost 33%. When a price goes up but the trading volume goes down, it suggests a real lack of conviction. It's like there aren't enough buyers to really push it higher with any force. And other key momentum indicators, they're all telling the same story. Indicators like the MACD and Stochastics, they basically measure the speed of price changes. And right now, both are showing that the upward thrust is fizzling out fast. It's like a car that's running out of gas. Both are flashing sell signals, and that's dragged the overall technical score down into bearish territory. The engine is definitely sputtering. So you've got long-term strength pulling up and short-term weakness pulling down. What happens when two opposite forces clash like this? Well, you get a standoff. You get this quiet period of consolidation that could be setting the stage for a much, much bigger move. Now, this kind of standoff has a technical name. It's called a Bollinger Band squeeze. Imagine you have two rubber bands around the stock price. When the price is bouncing all over the place, the bands are really far apart. But when things get quiet, like they are now, the bands squeeze in tight. It's like coiling spring. The tighter it gets, the more energy is being stored up for whatever comes next. And the data proves this squeeze is happening right now. The width between those bands has tightened to just under 6%, which is way narrower than its recent average. So yeah, that spring is definitely getting coiled. And if you need any more proof that we're in a standoff, just look at the ADX indicator. This thing measures trend strength. A high number means a strong trend, either up or down. A low number means, well, basically nothing's happening. The current reading of 11.54 is incredibly low, confirming the market is just completely directionless right now. It is the technical equivalent of a flat, calm sea for now. Okay, so with all this pressure building, where are the key levels? What are the lines in the sand that are going to tell us which side is about to win this fight? The chart has drawn some very clear battle lines for us. So here are the key numbers to watch. Above us, at 1174, that's the ceiling the bulls have to smash through to get back in control. Below us, at 1101, that's the floor the bears are trying to break. And right there in the middle, at 1120, that's the 20-day moving average we talked about. That is the ultimate battle line. And the analysis really just boils down to this one simple takeaway. A decisive, strong move above that 1120 battle line could mean the long-term trend is kicking back in. But if it fails to hold support just below that, it could mean the short-term weakness is taking over, and we could be in for a bigger drop.
So there you have it. Long-term strength versus short-term weakness. The bulls versus the bears. The market is coiled up tight, the battle lines are clearly drawn, and a big move is probably just around the corner. The only question left is, which way is it gonna break?